You can generate tax-free cash flow in your TFSA. How? Welcome to Real Estate Tax Tips. My name is Cherry Chen. I am a chartered professional accountant located in Ontario, Canada. We're on a mission to become the Google Maps for hardworking Canadians seeking financial freedom. Now, what you're about to see is how a TFSA can actually generate cash flow for you on a regular basis. I'll explain which stock market instruments that the government allows us to use that power this whole strategy. If you're not sure exactly what a TFSA is or how it works, then pause this video and go back to the previous videos in the series to get caught up. First, if you haven't subscribed to my YouTube channel yet, make sure you hit the subscribe button and turn on the little notification button below. That way, you'll get notified on the latest tax tip. If you like this video, make sure you give us a thumbs up. You can also ask me any questions in the comment section below, and I'll personally respond to you. Investing in your TFSA account is one of the only ways the Canadian government allows us to earn money tax-free. So why wouldn't we take full advantage of that opportunities? And one way to do that is by selling something called cover calls on shares that you own in your TFSA account. In fact, please meet Tim Hong. He's one of our Stock Hacker Academy students. In a recent post, he shared with us that he has been making an average of 3% monthly return in his TFSA account, primarily using this cover call strategy. He even withdrew his TFSA to fund his life insurance policy. But what are cover calls? How do they work? How do they actually equate to cash flow? Let's unpack all of that, and then we'll get into some examples. Before I get into cover call, let's look at what regular folks do. When we invest in stock market, we hope to buy low and sell high. We may buy the shares at $5 and hope to sell the stocks at $7 to make a profit. We wait for the stock price to go up, then sell it at $7 and realize a profit of $2 per share. It might take a week for the stock to go up to $7. It might get to a month. It might even take a few months before the stock gets to $7. In the meantime, you're holding onto the stock, not generating much return, especially those stocks that do not pay any dividend. What if you can make money while waiting for the stock to go up to $7? This is the exact strategy that Tim Hong used to generate his 3% average monthly return in his TFSA account. Let's look at a recent trade that he did in his TFSA account to explain. Tim bought 500 shares of HUT on Toronto Stock Exchange at $5.15 per share on July 21st. HUT is a company, cryptocurrency mining company. And he wants to sell these shares at $7.25. Now, he could wait for the stock to go up to $7.25 and sell them like all other regular folks do. And like I mentioned before, it may take a month for the stock to get to $7.25. It might take a few months, it might take a week, it might take a day. But we don't know. All we know is that Tim wants to sell it at $7.25. Instead of what regular people do, sit there and wait, that he sold an option contract agreeing to sell these 500 HUT shares at $7.25 each until August 20th. Essentially, Tim agrees to sell his 500 HUT shares at $7.25, which he would normally be agreeing to, and that's what he hoped to achieve. But there is an expiry date, so he commit to sell these shares at $7.25 on or before August 20th. In exchange for this commitment, Tim collected $44 while waiting for the share price to go up to $7.25. Fast forward to August 20th. HUT was trading at $8.22 per share. It is trading above the $7.25 that Tim committed to sell at. So the buyer of this option contract then exercised her right to buy Tim's shares out. She buys the shares at $7.25 because she can turn around and sell these shares in the open market at $8.22 and profit from it. In turn, Tim makes a total of that $1,096. Being the sum of $2.10 per share, the difference between $7.25 and his purchase price of $5.15 per share, plus an additional $44 he collected by selling that commitment, having that commitment. His initial investment was $2,574. His return on investment in 1 month works out to be 43%. Not bad, eh? You might wonder, did Tim just leave money on the table? Because he could have sold those shares at $8.22 on August 30th. Instead, he sold it at $7.25. Well, the truth is, Tim knew that he was going to sell the shares at $7.25. He would have sold the shares at $7.25 before the stock price went all the way up to $8.22. By selling the cover call, the only difference is that he was able to realize an additional $44 of cash flow. But what if HUT shares were to trade at $6 instead? So $6 is obviously below the $7.25 that Tim wants to sell it at. What if these HUT shares were trading at $6 on August 20th instead? Well, in that case, Tim could sell the shares at $6. The buyer of the call option would not exercise her right to buy Tim's shares at $7.25 because she could buy the shares, the same amount of shares, at a cheaper price at $6 in the open market. Nothing would happen to Tim's option contract. It expired. The only difference is that he made an extra $44 by selling the cover call. Stock options are promises to buy or sell 100 shares of a stock by a specific date if the stock price hits a specific price. If you're buying that promise, you pay a small premium upfront. If you're selling, you collect that premium immediately. And there lies the secret. We are selling a promise to sell your shares. We are promising to sell our shares by a specific date if the stock hits a specific price. For the promise, we'll pay a small premium. Let's look at another example. Let's say you own 100 shares of Cineplex. Stock ticker is CGX at $10. Right now it's trading between $13 and $14. If you're happy to sell those shares at $16 per share, then you could make a deal with someone for those shares. Let's say someone believes that CGX is going up strong in the next 50 days, so they're willing to pay you $1 per share right now for the right to buy CGX from you at $16 in 50 days. So you're promising to sell your 100 shares for CGX if it reaches $16 per share in 50 days. For that promise, you'll pay $1 per share right now. Because every option contract is for 100 shares, $1 multiplied by 100 shares equals $100. You collect $100 immediately. Okay, I can hear all your questions now, but what if the stock reaches $16 before the expiry day? What if it doesn't reach $16? What if the stock tanks? What if it reaches $16 but I decided I want to keep my shares? Let's walk through all of these questions one by one. What happens if the stock price reaches $16 before the expiry date? Well, if CGX is $16 or higher when the call contract expires, your 100 shares will be called away. That just means that you will sell your shares to the person on the other end of the contract, the buyer, for $16 per share. The stock price could be $18, but you would still be obligated to sell the shares at $16 to the call buyer. But you bought them at $10, so you're still making a decent profit. Plus, you collected $1 per share upfront, so you effectively sold the shares for $17 each. What if the stock price doesn't reach $16? What if the stock price slowly goes up but isn't quite at $16 when the call contract expires? Or what if it surges past $16 but then drops back to $15 and stays at that level when the contract expires? Well, most of the time, as long as the stock price is below your strike price, $16, on the expiry date, nothing happens. You keep your shares and the $100 premium you collected upfront. This is actually a great situation for many investors. They like the stock, they want to keep it for as long as possible, but they also want to collect some cash while they hold the stock. So they try to set their strike price high enough so that the shares don't get called away. This way, they can continue to sell cover calls over and over again, collecting premiums and accelerating their TFSA's performance. Of course, nothing is ever guaranteed. CGX could go to the moon and you would have to sell the shares, but as long as you're setting your strike price high enough, you'll always make a profit. In that case, you can wait for another pullback in the stock price and buy in again, then continue selling covered calls. What if the stock tanks? So check this out, option contracts have value. They have a price, right? Someone pay you $1 per share. They believe that was the value of your promise to buy CGX at $16 in 50 days. The value of the option contract is partially based on how close the strike price is to the current stock price. For example, let's say you wanted to sell CGX at $15 instead of $16. That strike price is closer and you could ask more for that promise, maybe $1.15 per share. Do you see how the value of a call can change based on what the price is doing? So if you were paid $1 per share, but then the price of the stock drops, it moves further away from your $16 strike price, well, the value of your contract will drop as well. This is good news for you. Let's say the value of the call contract is now worth 50 cents. You could buy back your promise and lock in the 50 cents profit per share, or $50 in total. When you buy back a call, you're not actually buying it back from the same person, but passing on that promise to someone else, someone who was willing to take 50 cents for that promise. So you're no longer obligated or bound by that contract, but you get to keep $50 profit. It can take some time to wrap your head around this concept, but you sold high and then bought low. Trippy, eh? This is actually the best way to profit from covered calls. Because once you've bought the call back and lock in the profit, you're free to sell another covered call to generate another $50 of profit from CGX shares. Here's a free tip though. Don't sell the covered calls again right away at the time when the stock dipped. Wait until the stock recovers a little so you can collect a bigger premium. What if the stock price reaches $16 but I decide that I want to keep my shares at the expiry date? This is a bit more complicated, but you have two options. Roll your call out to a further date, buy back the contract at a loss. Those are the two options. Rolling is when you buy your contract at a loss, but then sell it again further out in time, maybe even with a different strike price. Buying back the contract at a loss can be a tough pill to swallow because you're incurring a loss. But if you believe in the stock and truly want to hold on, then you have to stomach the loss. But there is a third option. Let the shares be called away and collect your profit. Then wait. When the stock dips again, buy more shares. Of course, you don't have to wait. You could buy right away as well. But the basic nature of stock price movement is 2 steps forward, 1 step back. Well, kind of. So wait for the 1 step back and buy in again. Okay, that's a lot of technical talk. Let's get back to making money in your TFSA. So how exactly does selling covered call benefit your TFSA account? First thing first, you're collecting extra cash flow on shares that you're otherwise just sitting in your account. You own it, you're waiting for it to go up in value. This cash flow builds up over time, compounding the returns in your TFSA, giving you more tax-free income when you want to start withdrawing money. Secondly, you can earn passive income on stocks that don't pay dividends. CGX is a good example of this. HUTS is a good example as well. They don't pay dividend, but by selling covered calls, you're still generating passive income from holding that stock. Granted, covered calls aren't as passive as dividends, but it's still extra cash in your TFSA. Thirdly, you can also look at selling covered call as a way to decrease the average cost per share every time you log in a profit. If you log in 50 cents profit per share on CGX, you originally bought those shares for $10 each, $10 minus 50 cents equals $9.50. And now your purchase price, your effective cost per share is $9.50. If you keep doing that over time, even if you continue to buy shares at a higher price, selling covered calls can keep your average cost down. Which means when you finally decided to cash out your shares and start withdrawing income, your profit could potentially be a lot higher than if you had just bought shares over the years straight. And this is the big picture goal. The more money you can make in your TFSA account, the more tax-free income you can draw on when you are ready to retire. Covered calls amplify your earnings. They put more cash in your TFSA, letting you buy more shares, compounding your returns over time. Imagine what this could do for you over 10, 20, or even 30 years. While we cover a lot in this video, we explain why investing in your TFSA is so important and powerful. Who comes to your mind when you see the power of investing in the TFSA? Who do you know that could really use this information? Would you share it with them? And if you found this information useful, hit that like button to let YouTube know that this was worth your time. If you want to learn more about tax-free saving accounts or tax tips in general, make sure you subscribe to my channel. If you have any questions relating to this video, make sure you comment below and I will personally get back to you. One last thing. We are preparing a TFSA Playbook to provide an overview of how TFSA works in Canada, the type of investments you can do to maximize your return on investment, and landmines and mistakes that you probably want to avoid. This TFSA Playbook will be available by the end of September. If you want to pre-order a copy now, visit tfsaplaybook.ca and download it for free. Okay, that's all. Thank you so much for watching.